even going to Chicago in his sleeper rather than consorting with teammates.
Welcome back, everyone. My name is Michael LeBlanc, Director and Senior Portfolio Manager at Canaccord Genuity Wealth Management, and it's September 1st. And today we're going to be talking about all things markets and what's going on in the financial world, and also touching on the U.S. currency weakness and what that means for portfolios and what that means for what's coming ahead as far as expectation goes when it comes to currency. Since we're so closely related to the U.S., it does affect things. So we'll dive into that. As always, before we get started, what we cover in the video is just for information purposes only. Don't use it as advice or to consider advice or use it as part of your portfolio decision-making process. And always reach out to a professional to get custom advice that related to your specific situation, or do your own due diligence before processing it. And we do try to keep everything as up to date as possible, but things are constantly changing. As I found out, I got a new version of our presentation just about 8 minutes ago. So if you are logged on early, you probably saw some jumping around on the screen there while I flipped out the presentation. So let's see what's in it. Before we get started though, we use Zoom as our platform here. So you are muted and your videos are turned off. But if you would like to ask a question, just click that Q&A button and you can type us a question, or as always, you can follow up with us with an email or a phone call. You can contact us really easily. If you go to mikeonmoney.com, you can find all our contact information, book appointments, reach out to us or follow us on any of our social media platforms. And if you're watching this on the replay, the same applies. Just go to mikeonmoney.com with any of your questions. You can give us a call or send us an email, and we're happy to answer any of your questions that you might have. So let's jump into things today. It is September 1st, so the start of the fall season. Back to school is coming up. I know there's a lot of concern and concern around that, and obviously uncertain how that might look, as all school districts and schools are treating things a little bit differently. I myself sent off this morning. My oldest flew back to Montreal, where he attends university, so hopefully things go well there for him. And we have a younger one starting high school, or grade 12, coming up next week. So we're constantly getting new updates as to how they're going to manage the kids going back. So to everyone who has someone going back, kids, grandkids, I wish everyone the best, and we'll hope we have a safe start. As far as the markets go with what's going on with COVID, this week we are looking for the business manufacturing report for August to give us an idea how manufacturing numbers are continuing. We are watching them worldwide. The ones we're waiting for this week are the US's. That's one thing that, you're going to see the theme here that as we cover, especially when we get into currencies. What we've seen around the world is a steady recovery, not back to the same levels, but a steady recovery since the reopening, I guess, or shutdown then reopening. But one thing that continues to plague the U.S. is a flattening of the numbers. So not as sharp recovery. So just continued trouble down there with all the economic numbers that we've seen. In the U.S., we have seen a slower number to the infection levels of the virus in the U.S., which is good. That continues in the last 3 weeks. We've mentioned the numbers continue to slow. They're still quite high, approximately 10,000 yesterday of new infections in the U.S., and as we'll see the numbers, they're approaching the 190,000 on the death mark. So still a going concern. But obviously slowing is a good trend. Some concern as the CDC down there has changed their testing parameters, and there's obviously a lot of conflict in discussions as to whether that is politically motivated or science motivated. So the numbers are coming down there, but there's some mistrust as to whether that just means they're not testing as many people as they were before. So we'll continue to watch as that plays out here. China private manufacturing is risen, as I mentioned, around the world. We are seeing the manufacturing, we are seeing the supply chain starting to improve since the closedowns. Even in areas that had some flare-ups, again, there's still the numbers are still improving economically, so that's good. Retail evictions are proceeding to pick up as the economy restarts. So this is something we talked about several weeks ago. Obviously during the height of the pandemic, or shouldn't say that. Hopefully we're past the height. Maybe we're not. But during the height of the crisis in March, obviously there was a lot of stimulus packages that went out. One of the big things was for retail or businesses to get some cash from the government, but also some protection from evictions. But as those government stimulus packages wind down, and we're going to see that here in Canada shortly as well, some of these companies got an extra lifeline during that process, but they still might not make it through this. So we're seeing a lot of retail evictions down in the US, and we're probably going to see those numbers in Canada. We're fully expecting the default, not just on rents, but even bankruptcy filings to spike here in the fall. And that's nothing that's none of the companies that will be surprising us. Most of them, we've been monitoring, or we would have seen that they were already in trouble, and they were surviving only on government money. And as soon as that dries up, they're going to have some challenges. So not a surprise we're seeing that down in the US. Beauty stocks is one where their numbers are coming out in the face of new reality. Of course, people not going into the office as much, or not going out as much. Things like cosmetic, personal care, hair care. We saw that a lot in the clothing as well, where a lot of spending shifted to things like Nike and Lululemon, as people were going for more comfort wear as opposed to work attire or more formal wear. And now we're seeing that in the beauty stocks. So not really surprised, but it is, is telltale that, there's different areas that were affected. Even though the businesses continued, sales have dropped dramatically as people's habits changed. California, on that eviction front, California has enacted an eviction moratorium. And this is actually for individuals more than companies, to protect people from being evicted if they've been affected by the coronavirus. So that's new. We've just put that in there. We'll have more details, but we'll probably hopefully see more and more of that. Obviously, eviction, especially in the United States, which goes onto your credit report, and of course that affects your ability to get something new. A lot of the people who haven't been able to pay rent, one thing in the US, there was no extra money kind of given to them. In Canada, we have the CERB benefits, and then on top of that, provinces had other rent benefits to help pay rent. The US didn't have as much in that way. They did have eviction moratorium that has run out now, but everyone who hadn't paid rent, it just accrued, right? So if they went 3 months without paying rent, they don't owe 1 month rent. They owe all 3 or 4, or how many they might have deferred. So a much bigger proceeding in the US than in Canada, hopefully. But we're looking at that very closely, because that's all tied to the unemployment numbers. Of course, if people are still unemployed and can't get work, they're not able to pay rent. So we'll continue to watch that as well. Airports starting to check flyers for temperatures. A lot of stores, retail stores are doing this. I suppose it's a minimal effort. We're also seeing a lot of airlines considering, actually, as the COVID tests get faster and faster, there's actually a newer one that's not in mass production yet, that results are 15 minutes, and it's a swab kind of in the mouth, as opposed to the more intrusive one that they currently do. And airlines are considering doing that as people before people board the planes, to try to bring some confidence back to travelers, try to get people more comfortable with flying, and make it safer on the plane itself. So we'll continue to see that. There have been a lot of contacts on planes, but I don't know if those numbers truly reflect kind of people's normal exposures. Obviously, when you go on a plane, it's been, they've done their best to fully clean it. Everyone has to wear a mask. They do the temperature checks. But we hear more about it on planes, I think, in travel than we do in general public, say your grocery store, just because they're able to contact trace very easily. Obviously, if one person reports in that they've come down with coronavirus, it's very easy to say, oh yeah, I flew last week, and then to contact everyone on that flight, or to publicly put it out in the press that, hey, that flight had an exposure, versus if someone comes down a week later with coronavirus and kind of say, who have you been in contact with? They might not report or remember every store they might have gone into, and consequently we don't get as many reports on that front. So I don't know that it's less safe in the airplanes. In fact, I'd probably argue that it might even be safer than kind of our day-to-day grocery store visits. But they're doing everything they can, and we'll keep track to see how that progresses, and how successful they are in controlling that. New York City had lined up layoffs for about 22,000 workers, and they've delayed that, obviously trying to keep the economy going and keeping everyone employed. Other things going on. We talked last week about we were expecting to hear more on monetary policy or mid last week, and we did hear, there's a shift in their approach. Their fundamental look at how they manage monetary policy, and they're really looking to not just stimulate the economy, but they want to try to help more on the lower end of the earnings curve. Obviously, the highest impacted have been minorities and in lower income jobs, or the kind of the hourly jobs without all the benefits. The white collar jobs have been less affected versus kind of the blue collar. So their new policy is that they want to focus on blue collar. However, they also said they don't know how they're going to do that. And also what they've done, or what they say they're doing immediately, which is keep the lending rates lower for a long period of time, tends to bulk up asset prices. So your real estate, because of the cheaper rates, people can finance more, and also the stock markets. But that really doesn't help the blue collar, which now is their new target. So not really sure how they're going to deliver on this shift, but it is obviously the area of the economy that needs the most help. But of course, now if they don't come up with a better plan, really all of what they're doing currently is the 1% in the U.S. They're making them richer, which of course makes a bigger wealth gap between them and the working class. So not probably what they want to continue. So we'll have to watch it more closely, as they really haven't laid out exactly how they're going to do this. And in fact, they said in the statement that they were going to pivot. They were going to change as the situation shifts, and they had no clear path to achieve this. So not the complete insight that we'd like to see, but hopefully it unfolds with more information as we move along here. Other headlines out there. U.S. consumer spending is risen strongly, but we'll taint that a little bit, of course, with the fiscal stimulus is about to end, or be decreased and slowly end through the fall here. So that number is probably not going to be able to hold. We'll see that taper off. There's an old saying that if you give a rich person $100, they'll put it on their pile. If you give a poor person $100, they go out and spend it. And of course, the U.S. government gave a bunch of money to those in need, and it was all spent. And that's where we're seeing the rise in spending. but they also gave a lot of money to some wealthy companies, and they've kind of just lined their pockets a little bit. So with that ending, we'll probably see a drop in the U.S. spending habits as we head into the fall. The Fed has no exact formula for the monetary policy, and I mentioned that they're not sure how they're going to deploy this framework, but obviously they are trying to target the area of the economy that needs help the most. Big news in tech: Apple and Tesla both split in their shares. Actually, took effect today for Apple. Tesla split in 5 stocks for 1. Which is a massive boost to the Tesla value, and Apple split in 4 to 1, which has been a holding of ours for a long time. So we're really happy to see that. It usually follows with a boost in stock price, which is exactly what we've seen. And the concept here is, Apple stock was north of $300. The idea was to make it more affordable, so more people would have access to buy it. It really doesn't change the value of the company. The overall value of the company stays the same. They just have more shares out there, so more liquidity, I guess, is the concept behind it. If you buy 4 shares of Apple at its new price, you don't own more of the company than you had 1 share at the old price. It does boost, I think the Apple would just pre this recording was trading about 130, so almost a 15-20% hike off the split price. So very positive for current shareholders, but I don't know how effective it is in the long run. Tesla had another big huge jump with their split announcement as well. So we'll keep an eye on that. Other ones that are up in that kind of level, MasterCard and Visa, both in those valuations, and we might, and you, of course, if you follow us here, I talk about those stocks a lot. We might see some splits coming from them as well, as they're in the same kind of pricing range. Wall Street's fear gauge, the volatility index, is actually rising. So as we'll talk about, we're seeing the markets get to new levels, or get back to their previous highs, or even newer highs, especially when we talk about technology. But the concern is, or the volatility index, or the gauge of how people feel, or how investors feel it's going to do in the near future, rose nearly 3% this week. So that's kind of what we've been talking about, that we were expecting this fall as a pullback. And that's not a big negative. I don't want to seem like it's all gloom and doom out there. It's just the market's got a bit ahead of the economy. That's fine. That was an opportunity. We've been taking some profits out of there. And if we see a pullback, that's just another buying opportunity. So nothing bad about that, but we are probably going to see some shifts in volatility here in the fall. As always, we'll take a look at the numbers. Worldwide number of cases, 25 million, almost 25.5 million. Deaths over 850,000. US over 6 million, so almost 6.2. And they're quickly approaching the 190,000 deaths. If you remember way back when, some of the worst estimates in March that the CDC had come out with was it could be 140 to 160. So obviously they've gone through that. Canada, we're through the 9,000 on the deaths and 128,000 on infected. It took us a long time to get through that 9,000 number, which thankfully we are through there now and moving towards 10,000. So hopefully we can control things here in the fall in Canada. We are seeing some more shutdown measures. Quebec is announced, they're going to dial back some of the open, slow things down. Ontario's doing okay with their phase 3, but both those provinces actually are mandatory masks everywhere, as opposed to BC, where our numbers have been increasing a bit. But we don't have the mandatory masks everywhere, so we probably are going to see that come to BC as they try to curtail those numbers as we move into the fall here. So let's take a look at the markets. We did see the markets higher last week. driven on technology stocks. As I mentioned already, Apple having a great run, and several others, and obviously Tesla as well. That rally's kind of continuing, although we have seen the last couple of days being a bit negative, and some reality, the fall reality starts to set in a little bit here. The 10-year yield fell on bonds in the U.S. Gold prices surged a bit. Surge is probably a strong number. It did go up. We'll dive into commodities here in a moment. The U.S. dollar weakened a bit more. Oil inched a little bit lower as the hurricane came through, and then rallied the last couple of days. So we'll dive into those numbers as well. Upcoming in the U.S., basically, again, continuing to watch the unemployment numbers. We did drop below the 10% unemployment just slightly, or sorry, it's expected to drop just below the 10%. The expectation is 9.8. So hopefully we see that. Still very, very high, but coming out of the double digits is positive. But we have seen kind of a plateau as far as those job creation numbers and new claims, have kind of evened each other out. So probably not spikes of improvement over the next couple of months, but hopefully we don't reverse trend and create more job losses. As we mentioned earlier, we're looking at that factory and manufacturing index to come out later this week as well. Also, banks in the U.S. are eyeing layoffs. They had said at the beginning of the shutdowns that they weren't going to do any layoffs. They didn't. They kind of didn't see the need. They wanted to stay strong. However, now that the first of all recession is confirmed in Canada and the U.S., but also that it looks like it's going to be a little bit longer than they expected. Now layoffs are back on the table, so we're probably going to see the banks do that, especially with unemployment numbers still staying high. They're expecting more loan loss provisions. So as that cuts into their bottom lines, they will look at cutting costs. Walmart has jumped into the fray to buy TikTok. If you've been following that story, TikTok, of course, is a social media platform based out of China, and the U.S. government, Trump in particular, has vowed to make it illegal or ban it in the U.S. As of September. I think the date changed slightly, but I'm going to say September 15th or thereabout. Ordering that it needs to be sold to banned in the U.S. or sold to a U.S.-based company. And we had Microsoft looking at it seriously. We had Twitter looking at it. Now Walmart's looking into it to try to tap into that youth market to be able to advertise to them, basically. So we'll see. Again, we continue to watch a lot of legal lawsuits around this whole situation. So we'll watch that continue to play out. Coca-Cola's cutting thousands of jobs as their sales were hit pretty hard. And a lot of that is also based on the restaurants and less people going to the restaurants, but the restaurants being closed. Obviously, a lot of their sales are through restaurants and through people going out. So they saw a big hit. So a lot of layoffs there. So again, not out of the woods when it comes to job losses in the U.S. J&J or Johnson & Johnson's start their mid-stage coronavirus trials in 3 different European companies. We talked a bit about that last week. So we're seeing a lot of the vaccines going to stage 3 trials, and we hope to see something come out of there. Again, we're seeing troubles though. Canada's out vying for theirs to do their testing. They just signed a new deal with Novavax, a company out of the U.S., to do trials and be part of it. But at the end, when we do get the vaccine, it's going to be who gets it first. Which country gets it first, and then who in the country gets it, and how quickly it gets disseminated around the world. So that's something that I think hasn't really been talked about a lot, but is going to be a major impact on how effective and how quickly that's going to help anything in the economy. Boeing continues to have troubles. If you followed the Boeing story, of course, anything airline related is having troubles as everything got shut down for travel. But Boeing pre that had their MAX 8 planes grounded due to problems, and problems meaning a couple of them fell out of the sky, and hundreds of people lost their lives. So they were hard hit, losing their best selling model, and their second best selling model, the 787 Dreamliner. They just found 8 of them with problems in the fuselage that they've taken out of service, obviously, as they try to correct that. But hopefully that's not another widespread issue for the model as Boeing continues to struggle in this environment. Up in Canada, we are looking at the industrial price, release of our industrial price index, and obviously building permit numbers for July. They did grow in May and June. Very little, obviously, in June, and we're looking to see how that went in July. Probably not a big increase to be expected, just simply because a lot of builders are kind of on that uncertainty. So any projects that they can delay, they have been delaying from diving into a long-term project until they see kind of how we get through the fall here. Canadian GDP is likely to rise in July, and much like we saw in the U.S., some numbers improving as we reopen, of course, from the pandemic pre-pandemic lows, the pandemic lows and the pre-pandemic levels. Can we get back up to those levels? It's going to be pretty difficult, especially with the oil and gas sector being in the state that it's in. Barrick and its partner firm in China are in a battle with Papua New Guinea, as the government there has given a bunch of lease to a state-backed firm over them. So they're in a dispute with that country. So a little bit of trouble for Barrick, although it's been doing quite well, as we talked about gold doing, being an inflation hedge and having a good rally, and also with Buffett investing in Barrick as well. As pandemic relief winds down, the banks are bracing for some new reality, and I mentioned this with the U.S. banks. Same thing in Canada. They're looking at credit impairments over the next year or two, as that unemployment number, as the government deferral programs and government aid, we had the mortgage deferral for individuals. A lot of people are going to be facing some expenses coming up here, and the banks are taking write-downs on that. So not to say we see anything bad for Canadian banks in the long run, but there is probably still a little bit of damage they've got to get through here in the next couple of months as the CERB benefits run out. On the foreign exchange front, the US dollar has declined a bit further as real yields have dropped. So real yields is the US yield less inflation. So obviously, as we've been talking about, inflation's rising and yields are at near zero in the US. So we're seeing that the diminish of the US currency. And we'll talk about that obviously in a lot more details here in a couple of minutes. But it fell by about 0.2% last week against, it's measured against a basket of global currencies. Commodities, crude oil a little bit up due to not as much damage from the hurricanes to the supply chain that was potentially expected. Also, we're seeing better numbers out of the Chinese manufacturing index, which has pushed the oil price up slightly. If you remember last week, I think we were sitting around 42.64. We're just above 43 a barrel this week. Still not great numbers, but not fallen, so that's positive. We also saw out of the U.S. the demand numbers were 15%, a 15.6% drop year on year from last August, which is in line what we were expecting. That with the COVID shutdown and the continued lack of travel, the world demand and U.S. demand on oil is not recovered, and we don't really see that kind of recovering for the next year or so, or certainly not to the pre-pandemic levels. We are looking to hear about the inventory data inventory data later today, just to see where they're at on their inventory storage. But the latest expectations are that their reserves have come down a bit due to the turning off of supply. As mentioned, gold rose, still not over 2,000 an ounce, but is at its highest level in the last 2 weeks, mostly on the weaker US dollar, and as investors continue to look at inflation as it may spike here in the next couple of quarters, people move to gold as a hedge to protect against that. So let's take a look at potential outcomes for a weaker dollar and what that means. So since the spike in March, mid-March, so when all this happened, everything shut down, of course, we talked about there is a flight to safety. When things look the worst, people or global investors tend to go to safety, and the US dollar, being an international currency and the main currency for trade, is seen as the safe play. So we saw a flight to safety for cash into the US dollar, and we saw that spike right in the heat of things in mid-March. But since then, the currency has fallen about 7%. After a decade-long bull market where we basically saw a 40% increase in the value of the US dollar. So it has, after a decade of climbing, we're now seeing some definite weakness in the US dollar. And that's brought on by many things, obviously shifting to a more bearish outlook on the US economy compared to the rest of the world, but also on rates, yield, with the US slashing their interest rates and their real yield going into negative. International global investors, global banks are moving away from the US dollar as they find better deals or better yield outside that and better outlook. So kind of pre-COVID shutdown, the US was, invested in the US money markets or US T-bills was paying almost 2% higher than, say, European or Japan. And now they're less, between 0.5% and 0.25% higher than those rates, with longer term risk as the economy in Europe looks like is rebounding faster and more steadily than we're seeing in the US. So a lot less demand out there for the US currency is driving down that rate. And as I mentioned, the inflation adjusted rate for the US, or the real rate, is actually the negative. So putting money into US T-bills right now, you actually lose money over time when you adjust your money out for inflation. So not a strong argument for putting money into the US greenback. Growth, as we mentioned, is likely to underperform other economies. What we're seeing in the US economic recovery, as I mentioned, is just not really improving numbers. We've had some good bounce backs. A lot of that has been on government spending. That can't continue. We know that. Unemployment still very high. Part of this is, really kind of, it'll be an interesting study. Some countries around the world obviously took much greater measures, much greater steps to close down or to protect and try to get rid of the virus or get the virus under control, where the US kind of took more of an eased or certainly a disjointed approach, and we've seen a lot of pockets, some areas never really slowing down, other ones continuing to spike. We've seen a lot of problems with the recovery, and that's slowing their economic recovery. So when we look at other countries that have gotten it under control, even with reopening, seeing some flares of pockets, their economies continue to grow through that because they overall have a bit better under control. In the US, we're not seeing that big spike or that continuing rise. We're seeing actually the numbers plateau, and obviously that lowers confidence for investors around the world into the US dollar. Politics, of course, politics come into this. We have a US election. The tensions between the US and China are, existed prior to the pandemic, but they are back. They're back very strong. As we mentioned before, today and last week, TikTok kind of being in the middle of all this, kind of an odd hill to die on, I think. But there is a lot of concern around the political situation in the U.S. and not the least of which is an election that's coming up, which um, doesn't matter who wins or lose, it is uncertainty. So that's going to add some extra pressure onto the currency until we get through that, and the world kind of gets a sense of what the policies of the government's going to be moving forward. Obviously, debt is a big issue. As the U.S. spends money and racks up debt, they have to finance that with foreign investment. So they have to attract foreign investment, and it's just a matter of supply and demand. So the more demand they have, they need to make it more attractive, which means it costs them more. And a weaker U.S. dollar makes it more attractive for foreign investors to invest in the U.S. To get that turnaround on the currency as it might improve over the next couple of years. So as they rack up debt, they're going to devalue the currency, and obviously with inflation rising and their commitment to keep the rates low, that will continue to erode the value of the U.S. currency. So how do you protect against that? Well, global diversification. Currency is always a risk in a portfolio, and it should always be taken into account when invested. Make sure that you're always either hedging against a currency shift, or that you're shifting your exposure to other currencies to offset what you might have at risk with your US dollar. We've mentioned before, we always tend to invest our clients with a domestic bias. So that's a Canadian bias, especially if you're spending your dollars here in Canada for the most part. But global diversification is always your best bet. You can, as we talked about in some of our other videos, you can also invest with a currency hedge. ETFs are great for that. Very, very low cost, which means you get the pure return of whatever you're invested into, but it takes the currency risk out of that investment. So it's just, if it goes up 5%, you go up 5%. You don't have to convert back and forth between currencies and potentially take that hit. So, make sure your portfolio, or make sure you're looking globally. We mentioned last week, one of the areas we really, really like right now is global real estate. It's at a 20-year low in value. It's a hard asset, great cash flow numbers. And it's perfect for diversifying away from the US dollar. And also emerging markets. Emerging markets tend to do better as they don't have to compete with the higher US dollar if it's come down in value. So those are some of the ways to take advantage of a weaker US dollar in your portfolios. And our outlook, which we always get asked, is definitely a lower US dollar over the next year or two. We might see we might see a bit of a spike to the recent decline, but probably won't hold that. Anywhere from 5 to 10% potentially down over the next year or two. We don't see the US dollar. People will often say, will the US dollar lose their reserve status, kind of their international status? We don't really see that big of a shift. And there's really no big contender. The euro would be, kind of number two, but it's very fragmented as far as the markets go and the transactions go. Really not centralized enough to take over. China's currency is not even freely tradable because they have capital controls in China over their currency. And only about 2% of the global financial transactions happen in that currency. So not likely to take over reserve status. So we got asked that a lot. But definitely, something to keep in mind. But obviously, we're not traveling. But cost of goods will be affected. Obviously, with a weaker U.S. dollar, could mean some cheaper items, especially things out of the U.S. As they come up into Canada. So just things to keep in mind. And again, just remember, keep your portfolios looking around the world. The pound is cheap. Euros poised for a potential turnaround. So there's a lot of good areas out there other than the US dollar. So with that, that's all I have. Thank you everyone for attending. As always, we'll do next week. This Friday, we're going to be talking about education. As I mentioned, kids are going back to school. So if you have grandkids, kids, and you want to learn more about saving for their education, we're going to do a deep dive into that this week. And as always, thank you very much. You can get a hold of us at mikeonmoney.com. You can find access to this video to replay and all our other previous videos as well as our weekly reports if you want to catch up on the latest news. But send us any of your questions or anything that you want to learn more about. We're always happy to hear from you. With that, thank you, everyone. Take care and have a great week.